This is the biggest mistake I see when people analyse property deals. And to be honest, it's the same mistake I made when I first started. I used to look at a deal, take the monthly rent, multiply it by 12, compare it to the purchase price, and think that I understood whether it worked. And on paper, it made sense. But in reality, the deals didn't perform the way that I expected. And once I started working on more deals, speaking to other investors, and seeing portfolios over time, I realised something quite quickly. Most property deals don't fail dramatically. They fail quietly. They sit there, they look fine, but the returns never quite materialise the way people expected when they bought them. And the reason for that is simple. Most people are only looking at income. They are not looking at the full structure of the deal. Now, this matters even more in today's market because in 2026, borrowing costs are higher than they used to be. Operating costs have increased and regulations are tighter, which means your margin for error is much smaller. So if your deal only works on a simple calculation, it probably doesn't work at all. Let me show you where people go wrong. The first one is cash flow. Most people think cash flow is just rent, so they see £1,200 per month and assume that that is what they'll be making. But that isn't cash flow. Cash flow is what's left after everything. So mortgage payments, maintenance, void, lettings costs, compliance, and all the unexpected things that come up throughout the month. I remember looking at one of my early deals thinking it was going to produce a solid monthly return. But once everything was accounted for, there was barely anything left. And that is a very common outcome. The second thing people underestimate is operations. A deal can look simple on paper, but in reality, it can require a lot of time and effort, especially with things like HMOs or multi-let properties, Airbnbs. Even with single lets, you still have tenant issues, maintenance, and ongoing management. And that workload changes how you should really think about the deal. The third area is risk. This is probably the one that gets ignored the most because people assume things will just run smoothly. But what happens if the property is empty? What happens if interest rates increase? What happens if costs go up or something breaks? If your deal can't absorb those changes, it is not a strong deal. And finally, exit. Most investors spend a lot of time thinking about how to buy a property, but very little time thinking about who they will eventually sell to. And that becomes a problem later. Because not every property has the same level of demand when you come to exit. Some rely heavily on other investors, some appeal to a wider market, and that difference matters more than people think. Once I started looking at deals through all four of these areas, everything changed. Because instead of asking, does this deal look good? I started asking, does this deal actually work? And that is where the core framework came from. Cash flow, operations, risk, and exit. If a deal is weak in one of these areas, it is not a clean deal. Now, in the next video, I'm going to show you exactly how I put this into practice. So instead of guessing whether a deal works, you can analyse it properly yourself in a few minutes. Because once you understand that process, you'll start seeing deals very differently. Thank you for watching, and I look forward to seeing you in the next video.